Sup traders, you're in the right spot tonight as we're getting into something very technical, which will help you with your systematic trading and your understanding of the markets. And we're going to look at nuances of asset class, how the different asset classes behave differently, and how you may take a basic trading system and would adjust the rules to try to optimize for that particular asset. And I'm not gonna go into the charts exactly, obviously we're offline, but I'm gonna explain to you also why Forex behaves differently from indices, behaves differently from metals, behaves differently from crypto. Okay, so a big picture is, in my opinion, it's better to trade every asset class than to trade just one asset class. Reason is diversification, having multiple systems running. Another reason is to, a lot of the times, you will not have that many opportunities in a particular market. It dries up, but there'll be a lot of opportunity in another market. And it's good to be more well-rounded. And personally, I'm trading all four in 3 different accounts, and maybe one account loses on the month, the other account wins. It's a nice diversification. But what I found is, if I slap the same basic system on a particular asset, it doesn't necessarily work as well for that asset and may need a couple modifications. So let's talk about a basic system and talk about some nuances. So this is my basic system. I'm looking at an old high and an old low. Specifically for me, I'm interested in old monthly highs. I focus on old monthly highs, old monthly lows. I'll also look at weekly highs and lows sometimes. We'll talk about that. But I'm focused on primarily monthly highs and lows, trading the daily chart. And I'm interested in the interaction of what happens. So say this is a daily chart. Here's an old monthly high. Here's an old monthly low. I'm not interested in trading anything in here. What I'm interested in doing is when price comes up and takes this old high, depending on how the daily closes and depending on how the asset is, I'm interested in trading. So the first is the daily closes under. To me, this is telling me that traders used the high as their profit target. We got to a high price, it's selling off. Sellers have the upper hand, shorts have the upper hand, and these breakout traders failed and are going to get stopped out, and it's a short setup. The other thing I'm looking at is price breaking out, which is telling me that whatever profit taking happened, we have a legitimate breakout. Price is going higher right now, the closed above. Buyers are in control, the trend followers are stepping in, and price is moving higher. Now, there's also variations where we close over and then we close under, or there's variations where we close under and then break out, in which case, typically I'm taking a loss and I'm getting chopped up when that happens a little bit. It's okay. Now, I'm also looking at what happens at the low, right? If we take out this old monthly low and price starts to move up and closes above it on the daily, then the sellers use this as a profit target, and people wanted to step in and buy at a low price. Buyers in control. This is a long. And the other one is, if price falls through the level and starts moving lower and closes below it, to me that's a sign that we have a legitimate breakdown. There isn't demand to buy here. Maybe there's another level lower to target from another low. It could be that, the sellers are in control here, buyers didn't step in. That's a sell. So I found that this signal works varying degrees on every asset, but it doesn't work the same. So let's start with Forex. Let's talk about Forex. So now fundamentally, Forex, when you're comparing two foreign currencies, it's just a gyration because essentially it's paper money. You're comparing paper money to paper money. Paper money tends to inflate. And regardless of what it is, there's times where one inflates way faster or one inflates way lower, but for the most part, it's pretty rare for a foreign currency exchange to like moon, right? Especially if it's a major country, it almost never happens, right? What instead happens is the policy moves back and forth, people buy. So when we're talking about Forex and we're looking at what might happen as price comes to that Forex, what might happen as price comes to this monthly high or monthly low, the first thing is, if price comes up here, I will trade a breakout, but I'm already anticipating reversal. I find that especially for Forex, there's 2 to 3 times as many reversal signals than breakouts. The breakouts do work, but we'll get to that in a minute. So I'm for sure not holding for a breakout. If I'm long up here, I'm for sure closing at the high. Okay? That's my take profit. No further. I'm expecting reversal. If we get the reversal, I'm selling, or if it's down here, I'm buying. I'm putting my stop there. Now, however, even if we reject, what's going to happen? We're going to chop, like Forex chops, right? So even if I have a sell here, I'm not looking to pyramid the position. I'm not looking to hold the position for a long time. I'm looking to get out quickly at 2 times my risk. I find that 2 RTP works well because it just doesn't really trend. You know, it chops back and forth. So on the other hand, if it goes ahead and breaks through the level and moves to a new high, I will trade it long, but I'm not pyramiding. I'm not trailing my stop. I'm looking for a TP at 2R and getting out at that. And if price ends up coming back, then I'm looking for a 2R sell. So with Forex, because it's paper money moving back and forth, because trends aren't really real, I'm not looking to pyramid positions. I'm not looking for big targets. I'm not looking to follow a trend and advance my stop. I'm looking to play a relatively short-term reaction. Hopefully it resolves within 2 days. Sometimes it might take a week or 2 weeks. Although if it takes that long, I'm probably going to move my capital into another opportunity. Yeah, so same signal, but fixed 2 RTP works well with Forex for fundamental reasons, right? So now let's talk about indices. Okay, coming back, high, low, right? So indices are different from Forex, where Forex is 2 paper currencies. Indices are paper currency and a basket of stocks. Now, stocks tend to go up over time for 2 reasons. The first reason is GDP tends to increase, like we tend to get more productive over time because of technological advancement. And the second one is because paper money is diluted with inflation, people like to save their money in stocks. They also, to a degree, they like to save their money in metals. They might like to save their money in crypto. But the most common is saving their money in stocks. They don't save their money in Forex. People don't say, well, I want to protect my money, I'm going to buy the pound. No, they say I'm going to invest in the stock market, which typically goes up 10%. So, same signal, price is coming up here. With Forex, I'm closing at the high and expecting reversal. With the index, since it tends to go up over time, I'm holding for a breakout. And I am pyramiding and I am trailing my stop. And I may have a TP up here, but we're at all-time highs. I probably don't have a TP. I'm probably going to exit if there's a big reversal day, not necessarily a big red day, but like a big wick. Or I'm going to exit if I get stopped out as I advance my stop. But my expectation is a breakout, and I don't necessarily trust the shorts here. if I do take a short, which I might not even take shorts, typically I ignore a lot of short signals on indices and look for the breakouts. I'm not looking to pyramid a short. I'm looking for a quick move down, maybe a fixed 2R like Forex, because it tends to be a volleyball underwater. And I'm looking to buy the breakout and pyramid into that. Now, I'm very interested in price coming down here. I'm not very interested in trading a breakdown in indices. If we come down to an old monthly low, I'm already anticipating reversal, and I'm anticipating this reversal being not just a buy, but a pyramid. I'm going to pyramid into it, and I'm going to set a big take profit and try to aim all the way back up here, instead of with Forex where I'm just getting out quick for something. Now, my bullish bias for indices, and this isn't just this year, there's all the time, and this tends to work decently in bear markets, is say we have an old weekly low down here. If price takes this old weekly low, not even a monthly low, I'm interested in longs. I'm not interested in sweeps of daily lows, but a sweep of a weekly low, I'm interested in longs because it's such a bullish asset, right? So, indices, we trade the same signals but different from can take the same signals but trade them different. Where Forex, I'm taking the same signal but it's fixed 2R. With indices, I'm ignoring a lot of shorts. I'm taking the weekly long with the same signal instead of the monthly as well. And instead of fixed 2R for the longs, I'm looking to pyramid and trail my stop and wait for price action to tell me to get out. Now, moving on to now metals and commodities, I'm going to mention gold is similar to indices because people save money in gold. People save money in gold because typically it inflates less than paper money. People don't tend to save their money in silver, platinum. Some people save their money in, very rare people save money in silver. Silver, platinum, agricultural commodities, and so on. So I would trade gold like I would trade indices, focus on longs, buy weekly sweeps, pyramid into longs, and keep the shorts as quick hits, and focus on shorting silver or platinum instead. So let's talk about commodities. Metals and silver and gold are similar to indices. They're more similar to indices than Forex. But the other commodities are different. So the other commodities are very interesting. So say we have, it could be wheat, it could be soy, it could be oil. One of these. Now, what's unique about the commodities is there's actual supply demand, right? There's actual supply demand of this is something that people need to use, that people need oil to get to work, to run their business. People need wheat for hamburger patties, for McDonald's, whatever. So this one is less subjective, the value of it. And what I've seen for commodities is if price is coming to an old high, is breaking old highs, there's a reason for it. And it may be an opportunity to pyramid. You can trade both ways still, but commodities have insane moves because the weather was bad in the Midwest and we didn't produce any wheat, and it's going to the moon, but it's going to come back now, right, in a big blow off top. So, but on the way down, as we're hitting these old monthly lows, they're not buys. So for commodities, which I'm not really trading, but I'm not interested in buying the monthly lows because you can linger forever. I'm interested in buying breakouts and pyramiding into them, and I'm interested in shorting rejections at monthly highs. Okay? So it's different, same signals, but I'm not taking the long buys at the bottom. I'm pyramiding the longs, and I'm pyramiding the shorts, because these things can actually have major trends. Now the last one is crypto, where crypto is something where it's inflated, actually, like Forex, because it's just made up currencies. So some of them tend to go up over time, but on a whole, a lot of them actually don't. So I would argue that crypto is now Bitcoin's a different beast. It tends to go up. Bitcoin's kind of in the gold class where people do invest in it. But ETH and altcoins are more trade a little bit more. I mean, it's like Forex in that they go up. Longs and shorts can be almost equal. It's not as smooth up as indices. However, when we talk about longs and shorts, for crypto, there's no use case like commodities. Most of them, there's speculative buying, but so for crypto, depending on what we're doing, I'm going to take the long signals and I'm going to take the short signals. Just the same. I mean, depends on if you're in a bear or bull market, because there's currency, right? Now with the basket of stocks, a company versus a dollar that inflates. Well, depending on the crypto, Bitcoin has less inflation than the dollar. It should go up over time. But on a whole, I would argue that the cryptocurrency market has more inflation than a fiat currency, because the barrier to creating crypto is much smaller than the barrier to creating a sovereign government money. So to me, longs and shorts are relatively equal, but like indices, they can be pyramided, although it tends to be the longs. What I found, the longs are easy to pyramid. Longs from the low and breakout longs are easy to pyramid. But you have these moves on crypto where you have this huge blow off top, and then you think, I'm just going to short this. And what happens is it just chops down like this. And by the time it retraces the move happened in a day, the retracement happened in a month, and if you add it on, you're going to get taken out on a retracement. If you advance your stop, you're going to take it out on a retracement. So I'm finding with crypto, with the shorts, you can take a short just like a long, but it needs to be a quick hit, like typically. I mean, you can think of it as an investment, but with all these other things, the moment you buy, you're expecting I'm either going to lose or I'm going to make a couple R within a few days. But with these crypto shorts, a lot of the time, it takes a long time to get your money with blow up tops. Now, a lot of the money actually can happen with breakdowns. So breakdowns are interesting for crypto. Trending breakdowns. A lot of the time, it happens in one day, and it's just too big. But depending on the asset, it works. So you see, with crypto, how the signals are a little bit different, where I'm not anticipating a reverse or a breakout. It could be either way. I'm going to trade either way. If it's a parabolic blow off top, I'm not actually that interested in shorting it, just because it's going to take so long to play out. My stop needs to be too wide. It's too jerky, right? So I'm interested in shorting failures at smaller moves, shorting breakdowns, longing the lows, and longing breakouts. But so those are the major assets, right? There's also bond, which I'm not going to talk about. I don't trade the interest rate market. It's not accessible to me. But I hope you found that helpful and useful. Those are some ideas on the nuances of asset classes, how they're all different. And I'm not telling you to copy my system in terms of taking entries and exits, but whatever system you have probably needs to be modified for the particular asset. But whatever system you do have, I encourage you to modify it for multiple assets, because that gives you diversification, which is a good thing to have. So hope you found that useful. Appreciate you. Much love, and look forward to talking to you in the comments. Peace.